You know, for decades, there was this golden rule in finance, a predictable little dance between the price of gold and the strength of the US dollar. But recently, that rule didn't just bend, it completely shattered, leaving investors and analysts scrambling to figure out, wait, what just happened?
Okay, so the classic thinking has always been like a seesaw. Think about it. Gold is priced in dollars, right? So if the dollar gets stronger, you need fewer of them to buy an ounce of gold, so its price tends to fall. And of course, a weaker dollar means the price goes up. This inverse relationship has been a fundamental market principle for as long as pretty much anyone can remember.
Right. So, what happens when a fundamental law of financial physics just stops working? That's the mystery we're going to unpack right now.
All right, let's dive in. Let's go back to the scene of the crime, so to speak, and pinpoint the exact moment this long-standing financial truth got turned on its head.
Okay, so starting back in 2023 and pushing right into 2025, something really weird happened. The US dollar index, that's what measures its strength against other big currencies, was holding strong. But at the same time, gold prices weren't falling like the rulebook said they should. Instead, they were surging. It was like both sides of the seesaw were going up at the same time, which, isn't supposed to happen.
The first big red flag that the old rules didn't apply anymore, that was when gold just blew past that huge psychological barrier of $2,000 an ounce. But wow, that was just the warm-up act.
And then, things got really wild. The momentum just became undeniable. As global tensions started to ratchet up, on April 10, 2025, gold prices just exploded. We're talking over $3,100 an ounce.
And believe it or not, it didn't even stop there. By October 2025, the rally hit a fever pitch, setting this absolutely jaw-dropping record high of nearly $4,400. I mean, the old rules weren't just bent, they were officially and spectacularly broken.
Okay, so that's the what. But the really crucial question is why? I mean, what forces out there were powerful enough to completely break a market dynamic that had held true for decades?
Well, it really boils down to three massive overlapping drivers. First, you've got soaring geopolitical risk. Second, a huge, and I mean huge, structural shift in who was buying gold. And third, these nagging, persistent fears about inflation that made gold's appeal as a store of value stronger than ever. Let's break those down. So first up, geopolitical risk. When you have major uncertainty in the world, things like the conflict in Ukraine, instability in the Middle East, all those trade tensions, investors do what they always do. They flock to safety. And what are the two oldest, most traditional safe havens on the planet? Yep, the US dollar and gold. But this time, investors weren't choosing one over the other. They were just running to both.
Now, the second driver was a really big one, a fundamental shift in global finance. As Open Markets put it, central banks significantly increased their gold reserves to diversify away from dollar-denominated assets. Basically, central banks, especially in places like China and Russia, went on an historic gold buying spree.
And you can't overstate the effect this had. It was profound. It basically created this powerful safety net under the price of gold. Suddenly, you had this new, massive buyer in the market that just wasn't as concerned with what the dollar was doing day to day.
So you put all these pieces together, and it's led to this fundamental rethink of what gold's role is in an investment portfolio. It's not just a simple hedge anymore. And this is really the key takeaway. Investors are now looking at gold's value as being tied less to the dollar and more to, well, bigger, scarier things. Things like real interest rates, what you earn after inflation, and the ever-present threat of major global crises.
And when we say systemic risk, we're not just talking about something like a stock market crash. No, this is bigger. We're talking about the danger of the entire global financial or political system having a meltdown. In that kind of context, gold is looking more and more like the ultimate insurance policy against a true break glass in case of emergency scenario.
Okay, the rule is broken, the game has changed. So living in this new reality, what should you be watching for next?
Well, a lot of analysis from financial news outlets points to some pretty clear advice. The big message is, don't panic. When prices take a dip, don't rush to sell. Instead, the smart money is seeing that as an opportunity, a chance to reevaluate your portfolio, maybe even buy a little more while it's cheaper, and always remember the long-term benefits of gold as a way to protect your wealth.
And looking down the road, it's not like the major players see this trend reversing anytime soon. Not at all. You've got Capital Economics forecasting gold at $3,500 by the end of 2026, while Deutsche Bank is even more bullish, predicting $3,800. The consensus is pretty clear. Whatever is driving gold higher seems to be here to stay.
And all of this leaves us with one final critical question to chew on. Have we just witnessed gold's evolution? Has it shifted from being just a hedge against the dollar to being a hedge against uncertainty itself? Because if it has, well, that changes everything.